Hello everyone. Welcome back to Prime Accounting Classroom. In today's lesson, we're going deeper into one of the most fundamental topics in accounting, the classification of accounts. This is not just theory, this is the foundation of the entire accounting system. If you truly understand this, you'll find journal entries, ledgers, and even financial statements much easier. So let's break it down step by step. What does classification of accounts really mean? In simple terms, classification of accounts means organizing all accounts into different categories based on what they represent. Think of it like organizing files on your computer. You don't just dump everything in one folder. You group them: documents, pictures, videos. Accounting works the same way. Businesses deal with many types of transactions, and to make sense of them, we group accounts into meaningful categories. This helps us understand transactions clearly, apply correct debit and credit rules, keep records organized, prepare financial statements efficiently. The three main classes of accounts. In traditional accounting, all accounts are divided into three major categories: personal accounts, real accounts, nominal accounts. Let's explore each one in detail with clear explanations and practical examples. 1. Personal accounts. Personal accounts are accounts that relate to individuals or organizations that a business deals with. In other words, these accounts represent who the business is transacting with. They can be grouped into three types. Natural persons. These are real human beings. Example: John, Mary. B. Artificial persons. These are organizations created by law. Example: companies, banks, government agencies. C. Representative personal accounts. These represent people indirectly through outstanding amounts. Example: outstanding salary, prepaid rent, accounts receivable. Golden rule for personal accounts: debit the receiver, credit the giver. Example 1. You pay John $500. John is receiving money, so debit John's account. Cash is leaving the business, so credit cash. Example 2. You receive $1,200 from a customer. Customer gives money, so credit customer. Cash comes in, we have to debit cash. Key insight: personal accounts always answer the question, who is involved in this transaction? 2. Real accounts. Real accounts deal with assets owned by the business. These are things that have value and help the business operate. They can be tangible, you can touch them, or intangible, you cannot touch them but they still have value. Examples of real accounts: cash, equipment, furniture, land, buildings, goodwill. Golden rule for real accounts: debit what comes in, credit what goes out. Example 1. You purchase equipment for $2,000 cash. Equipment comes into the business, so debit equipment. Cash goes out, we credit cash. Example 2. You sell furniture for $700 cash. Cash comes in, debit cash. Furniture goes out, credit furniture. Key insight: real accounts answer the question, what is coming in or going out of the business? 3. Nominal accounts. Income, expenses, gains and losses. Nominal accounts relate to business performance. They track expenses, money going out, income, money coming in, gains and losses. These accounts are used to calculate profit or loss at the end of a period. Examples of nominal accounts: salary expense, rent expense, electricity expense, sales revenue, interest income. Golden rule for nominal accounts: debit all expenses and losses, credit all incomes and gains. Example 1. You pay rent of $800. Rent is an expense. Debit rent. Cash goes out, so credit cash. Example 2. You earn revenue of $3,000. Cash comes in, we debit cash. Revenue is income, so we credit revenue. Key insight: nominal accounts answer the question, is this affecting profit or loss? Bringing everything together, let's look at a real-life transaction. You pay salary of $1,000 in cash. Step 1. Identify accounts. Salary is an expense, which is a nominal account. Cash is an asset, which is a real account. Step 2. Apply rules. Expense debit. Cash going out credit. Final entry: debit salary $1,000. Credit cash $1,000. Simple memory guide. Here's an easy way to remember everything. Account type. Focus. Rule. Personal account focuses on people, so debit receiver, credit giver. Real account focuses on assets, so debit comes in, credit goes out. Nominal account focuses on income or expenses, so debit expenses. credit income. Why this topic is extremely important. If you don't understand classification, you'll struggle with journal entries. You may apply wrong debit and credit rules. Financial statements may be incorrect. But once you master it, accounting becomes logical. You can analyze transactions quickly. You build a strong foundation for advanced topics. Pro tip: whenever you see a transaction, ask yourself 3 simple questions. Who is involved? That's personal account. What is coming in or going out? That's real account. Is it an expense or income? That's nominal account. This simple approach will help you classify any transaction correctly. Final thoughts. Classification of accounts is not just a topic. It is the language of accounting. Once you understand it, you'll read transactions like a story. You'll know exactly what to debit and credit, and accounting will start making real sense. If this explanation made this topic clearer for you, don't forget to like this video, subscribe to Prime Accounting Classroom, and turn on notification. See you in the next class.